Good afternoon, everyone, and welcome. Oh my, look at this. We need to fix this, don't we? Hold on. Man, there we go. All right. Welcome to SRT Live with me, your host, Sean Richard. I appreciate you being here today. This is your weekly market update for real estate professionals, as well as homeowners and home buyers. This is available to you as well because we're talking about the economy, we're talking about the housing market, and how all of the goings on are impacting those aspects of our lives. So I appreciate you joining me. Tough times lately. We've obviously got some headlines that are challenging or disturbing. We've got the Ukraine situation, and we've got a lot of people across the globe that are in turmoil. A lot of destruction going on, and so it's hard to watch and to listen to the things that are going on. And obviously, our hearts go out to the people of Ukraine, and just hopefully there can be some peaceful resolution to that in the not too distant future. So that being said, it's causing it's causing volatility to reign across the globe, and here in the U.S. And so I want to talk about today some of the implications of that. We've got a ton to go over today. I'm going to try not to make this an hour-long session. We're going to try and keep it at 15 to 20 minutes or so, but we've got a lot to cover. So let's dive right in. So today we got some key data. Now this, oh my goodness gracious. So if you're a homeowner and you're watching this right now, you need to be raising your hands in celebration. We got the CoreLogic Home Price Index report. So this tells us how homes are appreciating. And so we got a month over month and a year over year reading for the month of January. So January, and then last year to January. So month over month, 1.4% increase in prices. That's a month. That's 30 days. Year over year, up 19.1%. So this was an acceleration from the decline in appreciation that we saw from the previous month. The 19.1% increase is the highest level that this index has had in its 45-year existence. And so just think about that for a moment. We're seeing still north of 19, almost 20% increases in home prices year over year across the nation. Now, there are some key areas that are getting the bulk of that. You've got Phoenix staying red hot. You've got a few other areas of the country staying red hot, but in general, we're seeing extremely hot appreciation across the entire country. Here in Dallas-Fort Worth, we're seeing some phenomenal appreciation as well. Historically, we're in that 3 to 5% range, and right now we're seeing significantly higher appreciation levels than that, which means that buying right now, although challenging, is still a phenomenal opportunity to gain that wealth going forward. So some incredible opportunities to be a buyer as long as you can win that home. We also got the apartment list national rent report. So it's like, okay, well, I'm gonna wait. I'm not gonna buy right now, and I'm just gonna rent. Well, guess what? Month over month, rents are up 0.6%. Year over year, they're up 17.6%. So just lagging a hair behind home appreciation values. But here's the crazy part, right? So what is your typical rental agreement? It's for 12 months, right? So every year you're seeing that rent increase. Whereas as soon as you buy a home, although yes, taxes and homeowners insurance probably, they climb a little bit on a year over year basis, your principal and interest, your core mortgage payment, your interest rate fixed, your payment is fixed. Your core mortgage payment is fixed for the entire life of that loan. So that mortgage, that home ownership, a significant upgrade over renting because that rent is climbing on a year over year basis. And we're going to continue to see it do so for at least a while. Now, Obviously, we've got a huge focus in the economy on what's going on in Ukraine, that conflict. And the other half of the equation is the rampant inflation that we've been seeing. If you recall, the last CPI report, which is the Consumer Price Index report that we received, was the highest report since 1982, a 40-year high that we've seen. And so inflation is running red hot. Now, what does all of this mean? How is this dynamic working out in the economy? So ultimately, with inflation is the enemy of interest rates. So when inflation rises, interest rates are going to rise as well. And that's what we've been seeing. We've seen, interest rates on mortgages climb, roughly 0.5% since the beginning of the year, a full 1 to 1.25% year over year. And so we're seeing that play out. Now, we've got this conflict over in Ukraine. And so we've got, economic, and we've got world struggle. We've got world, turmoil. And what that typically leads to is a flight to safety. And we've seen that as well. We've seen the stock market take some plunges here lately. We've had a couple good days in a row, Thursday, Friday. The stock market is down again today by a healthy margin. And so where does that money go? Okay, when stocks and equities, when higher risk investments are being sold, where does that money flow into? And ultimately, it flows into safer investments, which include bonds, which that category includes mortgage bonds or mortgage-backed securities. And so when mortgage-backed securities, when those prices rise, that causes interest rates to fall. Mortgage bonds have an inverse relationship, or the price of mortgage bonds has an inverse relationship with mortgage rates. So as money is funneled into mortgage bonds, it pushes the price higher and it decreases interest rates. So think about that. We've got a very unique dynamic. We've got inflation running super hot, which is pushing interest rates higher. But we now have this conflict over in Ukraine, which is causing a flight to safety for investors, which would typically push interest rates lower. So we've got a tug of war in our hands. And the question is who's going to win this tug of war? And I don't mean to dummy it down, but that's really kind of at the core what it boils down to. Which direction are we going to see take precedence over the other, take priority over the other? So we saw a little bit of a delay in the flight to safety. We saw the market kind of tanking early last week. We didn't see a whole lot of movement in the mortgage bond market. Interest rates stayed relatively flat. They kind of still they increased a little bit. But as of Thursday, right? Yeah, as of Thursday, we saw that flight to safety, that movement of money into the mortgage bond market. And I'm going to show you this chart real quick, so that way you can take a look at this. And you've probably seen me show these before. Here we go. So this is mortgage-backed securities, mortgage bonds. So you can see that we, over the last, that's the beginning of February, right? Over the month of February, we really declined here. So again, this has an inverse relationship with interest rates. So as mortgage-backed security pricing declined, we saw interest rates rise. And then we saw them kind of stay stagnant for a little bit. And then we saw them rise. We saw the prices rise, and we've seen the interest rates come down. You can see the 10-year treasuries down 14 today. Mortgage bonds up, wow, a whopping 56 basis points. And so we've seen mortgage rates kind of rebound to the levels that we were at, right at the, maybe that second week of February, right there. So, so right now, we're seeing the conflict over in the Ukraine really take priority when it comes to the market here, that flight to safety with all that volatility across the globe. That's causing interest rates to come back down a little bit. And so the question really becomes, what does the Fed do? How does the Fed react to this? Leading up to the Fed meeting in March, prior to the Ukraine conflict, that there was a really good indicator that the Fed was going to increase the Fed funds rate, was going to hike the Fed funds rate. And there was talk about it being as much as 0.5%. Well, now that has all but dissipated. I mean, that's all but vanished. Right now, the increase in the Fed funds rate. One, if they increase at all, but two, what will the increase be? 50 basis points is basically all but off the table. I think there's about a 10% chance that there's going to be a 50 basis point increase in the Fed funds rate. And remember, that Fed funds rate, that's the short-term lending rate. So like when banks lend to each other overnight, the Fed funds rate influences that. So, will the Fed continue with their rate hike plan? Remember, rate hikes of the Fed funds rate are designed to help combat inflation. We're having inflationary issues here. You've seen it when you go to the grocery store. You've seen it when you're buying fruits and vegetables across the board. And so the Fed would be looking to increase that Fed funds rate to combat inflation. But will they still move forward that because of the conflict over in Ukraine? If they don't move forward with the Fed funds increase, or maybe say they don't do 50 basis points and they increase it only 25, is that enough to combat inflation? Are we going to see inflation continue to rise? And so that is the balancing act, the tightrope act that the Fed is dealing with right now. And although there's a lot of turmoil about it and the causes of this, it really is fascinating to see how this is going to play out, because it could go in either direction. And the fine line that the Fed has to walk is so critical, because if they don't react to try and combat inflation in a meaningful way, then inflation can continue to rise, and we're going to continue to feel it in our wallets. You've got stimulus that's been given out over the last couple of years, wearing off, and so we're starting to see a slowing of the economy, and with a slowing of the economy and a rising inflation, that creates what's called stagflation. It's a stagnant economy with rising inflation, and that's a big problem. That puts us in a position where the Fed may have to take some action and enact some monetary policy that is maybe unfavorable in normal conditions. So we really, really, really want to keep an eye on that. We're also feeling it, especially with the conflict over in Ukraine, at the gas pump. So oil prices are now up over $100 a barrel. This is the first time that they've hit that level since 2014. And so that ultimately will trickle down into gas prices. It's already started to do so. We've seen oil come from the 70s, $70 a barrel range, blew through the 80s into the 90s, and now we're up north of $100 a barrel. And so gas is going to continue to get a little bit less going forward. So we've got to watch that. Quick side note, if you own some Tesla stock or other electric vehicles, you're probably going to be doing pretty well over that. But I think we would all agree that keeping oil down and gas prices at a reasonable level is probably a better way to go than making a little bit of money on your Tesla stock. So watching what the Fed does in their meeting this month is going to be really important. And on top of that, we've got the State of the Union from President Biden tonight. And that has the ability to be a market mover as well. So depending on his course of action, what he brings to the table, how he's going to address are there going to be additional sanctions against Russia? How is that going to impact the market? In this global economy that we ultimately have, whenever we've got sanctions or we've got conflict and turmoil across the globe, we see that play out in our markets as well. I read an article this morning on Yahoo Finance that Visa and MasterCard were suspending their payment access to their payment systems to key Russian banks. And so, Visa and MasterCard are proactively doing that, but that obviously impacts their business. That impacts, the revenues that they drive. Even though it's obviously something that they felt strongly about that needed to do, which makes sense. It impacts us and our economy here in the United States. So all of these pieces that are playing out, the Fed meeting, the conflict in Ukraine, inflation, the State of the Union from Biden, these are all market moving activities, events that we want to keep an eye on to gauge what direction that we're headed and how they're going to influence our markets. If we continue to see aggression over in Ukraine by Russia, then it's believable to think that we could continue to see the market drop, more additional flight to safety, and interest rates declining a little bit further because of that. If here's the $1,000,000 question in my mind. So if we get a resolution to that conflict, let's say that Ukraine and Russia talk it out, and we get a resolution, are we going to rapidly reverse all of the damage that's been done? Are interest rates going to suddenly shoot back up because now the focus shifts back to inflation, which is a huge problem right now? Or is that something that we're going to slowly ease into? And so these are some interesting questions that we won't know the answer to until we start seeing some of this resolution. Now, looking at last week's numbers. So last week, every Thursday, we get the jobless claims. This is unemployment filings. So we have the initial filings, people filing for unemployment for the first time. And then we have continuing claims, people renewing their unemployment filings. And so last week, the expectation is we were going to have 235,000 new claims. We had 232,000. So pretty aligned with the expectation of the market. And continuing claims dropped from just about 1.6 million to just under 1.5 million claims. So we saw 100,000 continuing claims roll off there. And so that's going to be interesting to see what happens at the end of this week when we get the national jobs report from the Board of Labor and Statistics, the non-farms payroll report. Because if we saw that continuing claims, if we saw 100,000 or so roll off of that, does that mean those people found jobs, or now we're going to show up in the jobs report? So we may see a tick up in the jobs report numbers from that decrease in the unemployment claims. Last week, we also got GDP showing a growth of 7% year over year. That's obviously on the decline. We're in a slowing economy at this point. The lag on those reports makes it really easy to say, oh, our economy is still running full speed ahead, when in actuality, that's a look back. And since then, we've been slowing. And then we also received PCE, which is personal consumption expenditure. And this is the Fed's favorite measure of inflation. So you've got CPI, which is the consumer price index, and then you've got PCE, personal consumption expenditure. And the Fed focuses on this one. So we got month over month and year over year numbers. Month over month, the expectation was a 0.3% increase. And we actually got a 0.6% increase. So inflation still running hot, possibly heating up a little bit. And then we got year over year numbers. The expectation is we were going to get a 5.5% reading increase year over year. We ended up with a 6.1% reading year over year. So inflation showing that it is sticking around. I think we can look back to some of the Fed's comments last year where they talked about inflation being transitory. Although you could argue the definition of transitory, 3 months, 6 months, 12 months, like what exactly defines transitory? Obviously, inflation is not here for, the next, hot inflation is not here for the next, 5, 10, 15, 20 years. But we are seeing it stay hot. And so that's why the meeting in later this month with the Fed and what they're going to do with the Fed funds rate is going to be so crucial, because they have to find a way to balance combating inflation without putting our economy into a position where we just nosedive into recession. We also got pending home sales, which was down 5.7%. I believe this is month over month, and I apologize, I should have had that for you. And that being said, we've got a shortage of inventory. Inventory is down significantly from where it was pre-pandemic, from just 10 to 15 years ago. And so home sales, when compared to previous levels when we had more inventory, well, you can't sell what you don't have. So as inventory levels decline, we're going to see sales possibly decline a little bit, because it's going to continue to shrivel or dwindle down that inventory level. As we get past, or as we see inventory stabilize, we're going to start seeing smaller changes on month over month levels because we've got comparable inventory levels. If you have 1 million homes for sale and then a year later or 6 months later you only have 500,000 homes for sale, well, you're going to sell a smaller percentage of homes because there's less homes for sale. And so once you get to the point where, okay, well, 6 months ago there was 500, now there's 500, you're going to see smaller shifts from month to month in pending in home sales, both new home sales as well as existing home sales. So something to keep an eye on as well. Looking ahead, well, let's shift the focus to this week as well. So looking ahead, tomorrow we get the ADP payroll report. So it'll be interesting to see where that lines up in comparison with the jobs report on Friday. So tomorrow is going to be a little bit of an indicator. We also get commentary from Jerome Powell, Fed Chair Jerome Powell. He's going to be speaking tomorrow. He's also going to be speaking on Thursday. So it's rare that we hear from him that frequently. So with everything that's going on, we're going to hear from him a couple times this week. Anytime that he speaks, it's got the ability to move the market. So we want to keep an eye out for any clues to the Fed monetary policy that he speaks of. Thursday, we're also going to get jobless claims as we do every single week. And then Friday, we've got the big BLS jobs report, Board of Labor and Statistics. So we'll be getting that in the official unemployment rate reading. And so that's what we have coming ahead the rest of this week. So if that wasn't enough, we are, on that jobless report, the jobless claims, unemployment claims, we are getting a little bit closer to pre-pandemic levels. So we're starting to level off from an unemployment standpoint. That was a ton of data, a ton of information. There's so much going on right now, and it is creating a truckload of volatility. So that being said, my thoughts on where mortgages are heading and pricing is heading is I think we're in a position where we could see some continued improvement in pricing in the very, very short term, but we're in a very wide range. Let me show this to you one more time. So we are in a very wide range right here. And so we could be subject to a whipsaw. We could see that reverse quickly. And let's say, like I mentioned, the question is what happens if there is a resolution that's reached in the Ukraine conflict? Do we lose everything that we just gained over the last 3 days? Does this plummet all the way back down to where we were, Wednesday of last week? And so we've got to be on guard for that to happen. So keep an eye on that. If you have any questions, if you want to talk about this, feel free to reach out to me here at that contact information. Feel free to make comments below. Happy to have a chat with you. We can hop on a call. This is unprecedented times. There's a lot of, I say fascinating, believe me, I don't, it would be much better if this was more of a boring time and we could all focus on, other aspects of our lives, but there's a lot going on and a lot of information that's coming at us on a daily basis. So if you want to have more clarity around it, if you want to talk about what it means for your specific situation, or if you just, you want to buy or talk about, a potential refinance, reach out to me. My team and I are here to take great care of you. If you're a real estate agent, I hope that this information has helped you to educate your buyers even more, so that way you can help them make the best possible decision for their situation. Thanks so much for joining me on this week's market update. Have an incredible rest of your week. Thanks so much.